Corporate finance practice problem using OneNote. Rights offering, shares that could be acquired, calculation. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, note we're in the icon on the left-hand side in the Practice Problems tab down in the 1723 Rights Offering Shares That Could Be Acquired Calculation tab. Also note, when using OneNote, look at the Immersive Reader tool. Our practice problems will be down here in the text area as well. Same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have the information up top, calculation then on down below. We're looking for the rights offering once again, this time considering and calculating the shares that could be acquired if we're the person that is the shareholder with regards to the rights offering. So remember the typical scenario with a rights offering, and if you want some more detailed explanation of the rights offering in general, take a look at some of the prior presentations that we go into those practice problems in a bit more detail. Here, but just a quick overview, the rights offering corporation wants to generate cash, wants to get capital, wants to do so by issuing common stock. They've already got common stock out there. Therefore, they would like to basically give the current shareholders the opportunity to purchase the common stock at a discount. So they're going to be issuing out and giving the rights as a format of doing so. So when you're thinking about the rights, it's a temporary thing that's going to be taking place. They're going to be issuing the rights to the current shareholders. They have so much time to take the advantage of that opportunity, or possibly even sell the rights or something like that within that period of time. So the question, of course, is what's going to happen beforehand? What happens to the stock price? What happens to the dilution of the stock that's going to be taking place when this takes place? What's going to happen to the stock price afterwards, and so on. So let's say we're the owners and we have 3,000 shares required to buy one of the new shares. So after the issuance, in other words, they issue the stock rights, and if we're going to get one right per share, so we're going to assume that we get one right per share, that would be 3,000 rights for our 3,000 shares. We can then use them. We can take the 4 rights, so we get 3,000, one per share. If we could take 4 in order to buy one new share for the discounted price of the $45. So it would take 4 of the rights to buy one new share plus $45. That's going to be the subscription price to buy one new share. So they're currently selling for rights on the $75. We can kind of think about that as basically the market price before this takes place. Now, of course, once this takes place and this all is said and done, all else equal, you would think then that the market price would go down, because what's going to happen, they're going to be issuing more stock, more shares out there, and they're going to be doing so not at the market price, but at something underneath the market price. So you would expect then more shares going out. The cash is going into the company, which would increase the value to the company, but the cash coming into the company is not as high as what the market price was before the issuance. So you would think then afterwards the per share price, market value, would be going down a bit. Okay, so what's going to be the right value during the cum rights period? Calculation, stock price minus the rights subscription price per share over the number of rights required to buy one share plus 1. So if we do our calculation, then we're going to say the stock selling for rights on is 75. That's like kind of, you think of it basically the market price beforehand. The cash or subscription price, we're going to say is 45. That's the price that we can purchase for if we cash in our rights. Takes 4 rights in order to pick up one new share. The difference is going to be the $30. So we have the $30 at the difference. And we have the rights needed for one share. It's going to take 4 rights for one share, 4 rights to get one share plus the $45 for the subscription price plus 1, as our formula says. That's the denominator. So 30 over 5 is going to give us 6. I'll plug that in the calculator just for the fun of it. 30 divided by 5 is 6. So then that's going to be the value of one right then. That's going to be the value of one right during this period of time. Next, we'll take a look at the number of shares that can be acquired. How many shares can we purchase? So we have the number of shares owned, 3,000 shares that we have. We're going to get rights per share, meaning they're going to issue us a right as the existing shareholder of one right per share. Even though it takes 4 rights for us to be purchasing one new stock at the discounted price. So what are we going to get as current shareholders when this rights offering takes place? One right per share. We have 3,000 shares times 1, 3,000 rights. The number of rights needed per new share. So for us to take advantage of the rights and purchase the new shares at the discount, we're only going to get 1 share for every 4 rights. So that means that we're going to say, all right, that's 3,000 divided by 4. That means we can buy 750 new shares. We can buy 750 new shares, but we need, of course, money to do that. So how much is that going to cost us if we want to take advantage of this excellent deal that they're giving us? Well, the number of shares that we can acquire, 750, and then the cash or subscription price is 45. So in other words, we have enough rights at 4 rights per new share to buy 750 shares plus $45 per share that we want to buy. 750 times the 45 means that it would cost us $33,750 in order to basically purchase the new shares at the discounted price.